Did you know that JP Morgan, one of the biggest financial institutions in the world, might be playing fast and loose with the truth about the yen carry trade? Sounds shocking, right? Well, stick around, because we're diving deep into this financial scandal that could change everything we thought we knew. So, what's the deal with JP Morgan and the yen carry trade? If you're not familiar, the yen carry trade is a strategy where investors borrow money in Japanese yen at low interest rates and then invest that money in higher yielding assets elsewhere. It's a massive player in the financial markets, and any claims made about it can shake up the scene. Today, we're going to explore JP Morgan's recent statements and why they've raised some serious eyebrows. Let's break it down. Recently, JP Morgan released some statements claiming that the yen carry trade is more stable than ever and that it's a great opportunity for investors. They're painting a picture of a secure and lucrative strategy. But here's where things get murky. A lot of experts are questioning these claims. Some analysts argue that JP Morgan is downplaying the risks associated with the trade, especially in light of recent market volatility. There's a growing skepticism in the financial community about whether this stability is just a smokescreen to keep investors interested. So, what's really going on behind the scenes? Let's dive a little deeper into how the yen carry trade actually works. When investors borrow in yen, they're betting that currency will remain low while they invest in higher yielding assets, often in more stable currencies. This trade can drive demand for those currencies, impacting global markets. Now, JP Morgan's claims imply a level of confidence that suggests this trend will continue effortlessly. But here's the kicker: many economists are warning of potential shifts in interest rates that could jeopardize this strategy. If the Bank of Japan decides to raise rates, for example, the whole game changes. We could see a massive sell-off as investors scramble to cover their positions. That's a big deal. The broader context here is critical. Global economic conditions, geopolitical tensions, and market sentiments all play a role in the viability of the yen carry trade. Now, here comes the shocking truth. Recent data reveals that many investors are already pulling out of the yen carry trade, citing concerns about volatility and market manipulation. Reports have surfaced showing that JP Morgan itself might have vested interests in keeping this narrative alive to protect their own positions. This is where it gets really juicy. Evidence has emerged suggesting that JP Morgan may have misrepresented key data to support their claims. If this is true, it could mean they were trying to bolster their image while putting investors at risk. This pivotal moment could redefine how we view not just JP Morgan, but the entire financial market's integrity. To wrap it all up, we've seen how JP Morgan's claims about the yen carry trade have stirred up a lot of skepticism. With experts questioning the stability they're promoting and emerging evidence of possible manipulation, it raises serious concerns about the bank's credibility. The implications here are huge, not just for JP Morgan, but for investors everywhere who rely on accurate information to make their financial decisions. Is JP Morgan really trying to mislead investors about the yen carry trade, or is this just a case of miscommunication? Drop your thoughts in the comments below. And hey, if you found this video eye-opening, don't forget to check out our next video on the latest trends in financial markets. You won't want to miss it.